Let's get started with private equity earnings. We got a slew of them. KKR, Blackstone. What have some of the highlights been?
So Blackstone, with more than $130 billion fundraising haul, they're expecting another $100 billion this year. KKR itself brought in more than $20 billion. But look at how big Blackstone is in that room. KKR, with all of its assets under management, are still less than half the size of Blackstone. All of them diversifying strategies, but bringing in record fundraising.
All right, record fundraising and expecting more of the same this year. What are they doing with all that money?
So it's hard to put to work, right? And you're not seeing it all go into traditional buyout funds anymore. Direct lending, growth equity, so more private equity in Silicon Valley you're seeing nowadays. Blackstone touted kind of a sale leaseback agreement that they did. So direct lending, as I had mentioned. So you're really seeing edging out into different strategies as valuations are very high for buyouts.
One thing that we've seen in traditional asset managers has been fee compression and shrinking revenues or margins in particular. Are we seeing the same kind of thing in alternative asset managers?
Not close to what you're seeing in the rest of the asset management industry. You would think you would see it, especially as so many people are co-investing now, family offices raising money. There is competition in the private equity space, especially for all of its different asset classes, but you're seeing fees stay high as record fundraising hauls are still bought in.
Which is the reason probably why there continues to be the fundraising and this sort of aggressive push toward some of these alternatives on both sides, right? Because it's bigger returns for all parties involved, or that's what it has been. There was one particular negative in an otherwise solid earnings report for Blackstone, and that was the distressed debt unit, which posted a third straight decline, largely on the heels of distress in the shale patch. Katherine, do we have a sense of, are we close to the bottom here, how severe the losses will continue to be?
That is to be determined, but we're seeing a ton of volatility at the start of the year specific to energy, and that is what Blackstone, GSO's unit, was referencing when they've seen this third quarter of losses. Energy positions have caused a lot of trouble within distressed debt across the board, not just for GSO. So now that we're seeing a continued decline in oil prices and volatility within that sector, we could see more disruption to come.
Is anyone saying it's a buying opportunity? Because this has been going on for a while. I mean, granted, there was a recovery, but 2015, 2016 was a bloodbath, and we saw a lot of shale companies go bankrupt. Now we're seeing it kind of start again, and there's a feeling that it's going to get worse. Is anyone saying, well, there could actually be opportunities?
So here's the complication here. A firm like GSO will look at these companies and they see the prices and they say, this is a cheap price for what we're getting, and so we'll jump into it. But the prices have been dropping even lower. And so if you think that you're getting in at the bottom, but then that bottom just keeps going lower, well, that's when you start to get burned. And that's specific to all distressed across the board.
We call that catching a falling knife.
Exactly. Which, I hear that phrase a lot.
Meanwhile, we're starting to see some types of debt getting issued that are typically associated with froth. I'm talking about PIK toggle, dividend payouts. Davide, can you give us some examples?
Sure. So it's been a strong start for leveraged loans and junk bonds so far this year, and we did see a few of these deals pop up. There's one in the market right now for a company called Husky, which is owned by private equity firm Platinum Equity. So $450 million. It's still smaller compared to some of the transactions that we saw last year. But just to give you a sense of how well some of these deals are going, there was a dividend last week for Tillman Fertitta, the owner of the Houston Rockets and Texan billionaire, out of a company called Golden Nugget that owns its casino and restaurant holdings. Not only investors allowed Tillman to double the size of the dividend that he was seeking for $200 million, but they also agreed to charge him a lower interest rate for that debt.
I'm curious, do we have a sense of what the demand is like for some of these deals? I mean, are investors requesting or demanding very high coupons for it, or are they being pretty lenient in terms of their willingness to part with their cash?
It really depends on the company. So in the case of Golden Nugget and Tillman Fertitta, they actually agreed to a lower rate. It remains to be seen if other companies will be able to pull that off. It usually is a question of how levered the company is, how good it, as well as how well it has performed since the last dividend or since the buyout. And so investors will be weighting all those issues.